please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, 2017 has been a glorious year for mutual funds. Latha Venkatesh and Anuj Singhal discussed with top mutual fund managers to know what 2018 looks like and if the Indian markets will be able to sustain the growth going ahead. Take a listen.
So two ways to look at it. So India has participated in the synchronized global equity rally. We haven't fully participated in the synchronized global growth. The growth cycle is yet to begin. Even from the profit perspective, the profit cycle hasn't really reached the end state. And I think we have a long way to go from that perspective. But always, markets front load a lot of those returns which we are likely to see both in the economy as well as in the corporate profits. May not be able to repeat what we have seen this year, particularly in the mid and small cap space. But I think as long as over the next several years we have a good economic cycle and the profit cycle, equity markets can deliver decent returns.
Okay. Well, even if say 45% is obviously a tall order and a tall goal to set, would you say, Manish, that this is a market where the downside quite clearly is protected simply because both liquidity and growth are certainly on the side of the investor?
So clearly from a valuation perspective, you have downside because obviously you're trading much above your historical valuations. But as was pointed out earlier, from an earnings perspective, so over last 8 years, your earnings CAGR for Nifty is 4%. So clearly from an earnings perspective, you're protected in the sense that you're starting off from a base which is very, very low. So I would think it's a market of middle level attractiveness. Valuation is a bit expensive, but next 3-year compounding in earnings can be 15-20%, so which should be quite healthy.
Retail investors have made a lot of money and their hopes would be high for 2018. What kind of return expectations should they have, especially for SIP investors going forward?
So essentially, Anuj, inflation has come down. From double digit, we are in single digit, mid-single digit. By definition, returns will have to come down in nominal terms, even if real return remains the same. So that's one way to look at moderation in return. The second way to look at is valuation-wise. We are today trading at reasonably fair valuation. Now, if you invest in a bear market valuation, exit at bull market, you make a lot of money. But if you enter at fair market valuation, your returns will have to be moderated. The third way to look at is commonsensical. In 2017 and 16, we had a betting pitch where we could score run quite freely. 2018 is going to be a bowling pitch. Inflation is on way up, though not as high as it was before in double digits. Interest rates are on way up, though it won't go as high as the previous cycle. And most importantly, globally, central bankers are withdrawing liquidity. In some sense, I call them Rajnikant effect. Like the southern superstar who could do anything, the central bankers have done anything. There was a problem, they threw the money, liquidity showed up the market, asset value. On one side, it created frenzy where a picture goes for a $450 million price tag. In 2018, those central bankers will retire or gradually take out liquidity. And that will have an impact on asset value. So whichever way you look at it, inflation-adjusted return, valuation-adjusted return, or simply liquidity-adjusted return, 2018 will be a year of moderate return compared to 2017, and hence SIP investors should just moderate their expectations.
The mid-cap index has outperformed 20% this year compared to the Nifty. Last year it was outperforming the index by 6%, and I think previous year as well. So it's been a bottom-up stock picker's delight, our market that is. But do you think it's now getting a bit vulnerable? As a fund manager, are you finding enough listed stocks now in the mid-cap basket to put incremental money, or are you now looking at only the IPOs to park the incremental money?
Clearly, what has happened is, as AMCs over the last 1.5 years, we've been marketing large caps. But large caps continue to underperform, and the reason we recommend large caps is because there's a huge margin of safety in large caps. As Manish pointed out, earnings has been muted for years on end now, that you have a lot of margin of safety in large caps. But if you ask me, do mid caps look cheap? The answer is no. They look very costly relative to large caps. But just like this bull run can go further, you have a situation where large caps have margin of safety but lower returns. So it's much wiser for a mutual fund to push large caps than to push mid and small caps now.